What if the same exchange that once raised margins 6 times to stop a silver rally has now signaled that the opposite might happen? This is not a theory or speculation. It is exactly what CME Group announced yesterday at 4:47 p.m. Eastern Time. Surprisingly, very few financial media outlets are explaining what this could actually mean for the silver market. COMEX has just reduced silver futures margin requirements by about 30% overnight, dropping the requirement from around $18,500 per contract to about $12,950. This is the biggest single margin reduction for silver since 2020, and history shows something very interesting when this happens. The last time margins were cut this aggressively, silver was trading around $18. Within 12 months, the price reached $30. Before that, silver jumped from $14 to $28 in only 8 months after a margin reduction. In other words, every major margin cut in COMEX silver over the past decade has been followed by a strong price increase. On this channel, we do not celebrate or panic. Instead, we study the exchange filings, read the margin schedules, and focus on what the actual data says. If you want analysis that treats you like a serious investor, this is exactly the type of change you should understand before the market fully reacts. To understand why this matters, we first need to understand what margin changes actually mean. Right now, silver is trading around $87.40 per ounce in the spot market, which is about 2.3% higher than yesterday. Gold is trading near $220. The US dollar index, DXY, is around 97.2, near one of its lowest levels this year, and oil is trading close to $84 per barrel. On the surface, this looks like a normal day in commodities. Metals are slightly higher, the dollar is slightly weaker, and nothing appears unusual. But beneath the surface, something important has changed that affects every leveraged silver trader. The CME Group, which operates COMEX, announced a 30% reduction in initial margin requirements for silver futures contracts, effective immediately. There was no warning and no gradual phase-in. It was a single announcement that instantly lowered the margin requirement. Yesterday, a trader needed about $18,500 in their account to control one silver futures contract. That contract represents 5,000 ounces of silver, worth roughly $437,000 at current prices. Today, the same trader only needs about $12,150. That means traders now require about $5,500 less capital per contract. And across hundreds of thousands of contracts, this change frees up billions of dollars in trading capacity. Most financial media will say this is routine. Exchanges adjust margin requirements based on volatility. If volatility drops, margins are lowered. Technically, that explanation is correct. However, history shows a deeper pattern. To understand why this matters, we need to look at how COMEX has used margin changes in the past. In 2011, silver prices surged from around $18 to nearly $50 per ounce. The rally was extremely fast, and many retail traders rushed into the market. At that moment, the CME Group raised margin requirements 5 times within 9 trading days. Margins increased from about $11,745 to $21,600 per contract, an 84% increase in less than 2 weeks. The effect was immediate. Many leveraged traders could not deposit the additional funds required, forcing them to sell their positions. Silver quickly collapsed from $49 CD2 to about $30 to $50 within a week. This became the typical playbook. When silver rallied too quickly, margin increases were used to slow or stop the rally. But the opposite pattern also appears repeatedly. Whenever margins were reduced during weak markets, silver often rallied afterward. In March 2020, during the global market panic, silver crashed to around $11.70 the setting. Over the following weeks, COMEX reduced margin requirements. Within a year, silver surged to nearly $30, a gain of more than 150%. Something similar happened in 2015 when silver was trading near $13.80. After margins were reduced, silver climbed above $21 within months. A similar pattern appeared again in 2018. The pattern is clear. When margins are raised, rallies often stop, and when margins are reduced, rallies often begin. Now COMEX has cut margins by 30%. The updated margin schedule from CME Group shows initial margin falling from $18,500 to $12,950, while maintenance margin dropped from about $16,818 to $11,073. Current open interest in COMEX silver stands at around 147,000 contracts. At the previous margin level, traders needed about $2.72 billion in total margin to support those positions. With the new margin level, the requirement falls significantly, freeing roughly $820 million in margin capacity. That capital can either be withdrawn from accounts or used to open additional positions. Historically, around 65% to 70% of freed margin capital gets reinvested in the market within 30 days. If that pattern holds, the freed capital could support about 41,000 additional contracts. Since each contract represents 5,000 ounces, that equals roughly 205 million ounces of additional paper silver demand. Now compare that potential demand with physical supply. Registered silver in COMEX warehouses currently stands near 71.3 million ounces and has been declining steadily in recent months. This means potential paper demand could be several times larger than the available physical inventory. However, it is important to consider the bearish possibilities as well. Margin cuts do not guarantee higher prices. Sometimes exchanges lower margins simply because volatility has decreased. Traders could also use the cheaper margins to increase short positions instead of long positions. The US dollar index, DXY, is another important factor. If the dollar strengthens due to interest rate changes or economic uncertainty, silver prices could face downward pressure. Therefore, the margin cut alone does not guarantee a rally. What makes the situation different today is the broader supply environment. The global silver market has been in a structural deficit for several years. Demand from industries such as solar energy, electronics, and investment continues to grow faster than mine production. This means the physical silver market is tighter today than it was during previous bearish cycles. At the same time, large banks have gradually reduced their short positions over the past year. Interestingly, CME Group also reduced gold margins in the same announcement, but gold margins were cut by only about 18% compared to silver's 30% reduction. This difference raises an important question. Why cut silver margins much more aggressively than gold? One possible explanation is that the silver market needs additional liquidity. Lower margins attract more traders, increasing participation in trading activity. When all these factors are combined, the situation becomes very interesting. Silver trading just became significantly cheaper. Historical patterns show margin cuts often appear before major price moves. Physical supply is tightening, and institutional positioning is slowly shifting. Most traders will simply see silver move a few percent and assume nothing important has happened. But sometimes, the real story is hidden in the rules of the market itself. Exchange rule changes often shape the next major price move long before headlines recognize it. So the real question now is simple. Will silver repeat the historical pattern after this margin cut, or will this time be different? Only time will tell. But one thing is certain. The rules of the game have just changed.